Disclaimer. Yes, the dream is over. Bitcoin is dead again for the 462nd time. Look, I know exactly what you're feeling right now. I can see it in the comments. I feel it in the DMs. I can sense the panic spreading across Twitter, YouTube, and Reddit. People are scared. People are selling. People are convinced this is finally the end. And I get it. I really do. Bitcoin is sitting around $63,487 right now. Earlier today, it dipped close to $62,000. That's almost a 50% collapse from the all-time high. The fear and greed index, 12. That's extreme fear. Over $2.5 billion wiped out in liquidations. ETF money flowing out. Mainstream media already celebrating, declaring victory. It looks bad. It feels worse. The charts are brutal. But before you panic, before you sell, before you make a decision you might regret, let me show you something I came across this morning. I was digging through data, on-chain metrics, institutional flows, analyst research, and then I stumbled onto a website, a site called bitcoindeaths.com. This website exists for one reason and one reason only: to document every single time Bitcoin has been declared dead by the media, economists, critics, and financial institutions. Every obituary, every funeral, every confident declaration that this time it's really over. And do you know how many times that's happened? 461 times since 2010. 461 documented deaths. But here's where it gets almost comical. The site has a chart showing Bitcoin's price over time with every one of those death predictions marked on it. And at the bottom of the page, there's a sentence that stopped me cold. Bitcoin has been declared dead 461 times. If you invested just $100 every single time, you'd have over $66 million today. Let that sink in. Not from timing the top, not from being a genius trader, not from leverage, options, or insider information, just from buying when everyone else was panicking. Just from stepping in at moments of maximum fear. Just from doing the exact opposite of what the headlines were screaming. So before we go any further, take a breath. You're not the first person to feel this fear. This moment has happened hundreds of times before, and every single time the people who panicked sold at a loss. Every single time the people who stayed calm were rewarded. Right now, the internet is in full meltdown mode. Twitter is packed with "I told you Bitcoin was a scam" posts. YouTube is flooded with "why I sold everything" thumbnails. Financial TV is rolling out the same critics who have been wrong for over a decade. Crypto winter, bubble popped. End of digital gold, same script, same panic, same confidence. And every single time, Bitcoin came back. Why? Because price crashes don't change fundamentals. They change perception. And perception is temporary. Let me take you back. In 2011, Bitcoin was trading at $233. Wired magazine published an article titled "The Rise and Fall of Bitcoin." Nobel Prize winning economists called it a pyramid scheme. Bitcoin was officially declared dead. Today, Bitcoin is over $63,000. In 2013, Bitcoin crashed from $1,000 to $200. Paul Krugman declared it worthless. In 2018, Bitcoin collapsed from $20,000 to $3,200. The New York Times, Bloomberg, CNBC, all declared it finished. In 2022, Bitcoin fell to $15,500 after FTX, Luna, Celsius, and Three Arrows collapsed. Experts said this time was different. The fraud had been exposed. Bitcoin went on to hit $126,000. Do you see the pattern? The obituaries always arrive at the bottom. The declarations of death always come at maximum pain. The experts always call it perfectly, in reverse, because they're not analyzing the system. They're reacting to the chart. They see price going down and assume the asset is broken. They never ask the right questions. Is the network still running? Are transactions still processing? Has the technology failed? Has adoption reversed? The answer is always no. Blocks keep getting produced. Miners keep mining. Transactions keep clearing. And smart money keeps accumulating while retail panics. This isn't random. This isn't accidental. This is how Bitcoin works. Crashes transfer Bitcoin from weak hands to strong hands, from emotional sellers to patient buyers, from people who don't understand it to people who do. Price goes up. Retail FOMO's in. Price crashes. Retail panic sells. Whales accumulate. Repeat. And right now, we are in the phase where everyone is convinced it's over. This is not financial advice. I'm not telling you to buy or sell. I'm showing you history, structure, and behavior. There's a massive difference between disciplined investing and gambling with borrowed money. One survives these moments, the other doesn't. Now, here's what makes this moment interesting. Stocks are near all-time highs. The S&P 500 is strong. Corporate earnings are solid. The broader economy is still expanding. Meanwhile, Bitcoin is down nearly 50%. That's not weakness, that's divergence. Capital is rotating away from volatility and toward perceived safety. Fear is driving decisions. But history shows that these divergences don't last. When Bitcoin underperforms during fear, it doesn't just recover, it explodes during the next liquidity expansion. Not by a little, by multiples. And right now, we are in the underperformance phase. The phase where people give up, the phase where headlines scream collapse, the phase that has quietly preceded every major Bitcoin recovery in history. This is the 462nd time Bitcoin has been declared dead. And if history rhymes, it won't be the last. Now let's talk about the elephant in the room, institutional money. Because this is where the narrative completely breaks down. You've probably heard the same argument repeated everywhere. ETFs are seeing outflows, institutions are leaving, smart money's gone, Bitcoin is finished. But that interpretation misunderstands how institutional capital actually works. Institutions do not buy tops. They do not chase green candles. They do not FOMO into euphoric markets. They wait for pain. They wait for capitulation. They wait for moments when retail gives up. When Bitcoin was trading at $126,000, institutions were not aggressively buying. They were cautious. They were patient. They were watching sentiment, leverage, and positioning. As price started to fall, retail assumed that meant institutions were abandoning the market. In reality, it meant the opposite. Institutions were waiting for forced selling to do the work for them. Look at MicroStrategy. They are the largest corporate holder of Bitcoin on the planet. Hundreds of thousands of coins accumulated over years. Their average purchase price is well above current levels. Right now, on paper, they are down. And yet, during this drawdown, they bought more. Not because they're reckless, not because they're emotional, but because their thesis has not changed. Michael Saylor has been clear for years. Bitcoin is not a trade. It is a long-term monetary asset. Temporary price volatility does not alter that thesis. If Bitcoin were truly dead, if the fundamentals were broken, if the long-term outlook had deteriorated, MicroStrategy would not be increasing exposure while sitting on unrealized losses. They would be cutting risk. They are doing the opposite. Now look at BlackRock, the largest asset manager in the world. Trillions under management. A reputation built on risk management, not speculation. BlackRock does not create products for assets it believes are going to zero. Yet, during one of the largest drawdowns of this cycle, BlackRock expanded its Bitcoin offerings. That alone should tell you everything you need to know. Institutions don't operate on Twitter sentiment. They don't react to headlines. They don't panic. They operate on data, probabilities, and long-term adoption curves. They see Bitcoin not as a chart, but as infrastructure. And infrastructure doesn't die because price drops 50%. Now let's talk about ETF outflows, because this is where people get confused. ETF flows are noisy. They move daily, weekly, monthly. Outflows during periods of fear are normal. Retail exits, short-term traders rotate, but zoom out. Since launch, Bitcoin ETFs have absorbed tens of billions of dollars in net inflows. They hold a meaningful percentage of total supply. That is not capital leaving Bitcoin. That is capital locking it up. And here's something most people miss. Every Bitcoin that moves into institutional custody is effectively removed from liquid supply. Those coins are not day traded. They are not panic sold. They are held, which means future supply shocks become more violent. Now let's talk about sentiment, because sentiment drives price more than fundamentals in the short term. The fear and greed index is deep in extreme fear territory. Historically, extreme fear does not coincide with market tops. It coincides with exhaustion. It marks the point where sellers are largely gone. It marks the point where the people who wanted to sell already have. That doesn't mean price immediately reverses. Markets can stay irrational longer than expected. But it does mean risk to reward starts shifting. Now we need to address leverage, because this is the silent killer. Billions of dollars in leveraged positions were wiped out in days. These were not long-term investors. These were not disciplined participants. These were gamblers borrowing money to chase upside. When price moves against leverage, exchanges force sell positions. That creates cascading liquidations. That pushes price lower. That triggers more liquidations. It looks like organic selling, but it's not. It's mechanical. And once that leverage is flushed, the market becomes healthier. Less leverage means fewer forced sellers. Fewer forced sellers mean more stability. More stability allows accumulation. This is why the largest crashes often precede the strongest recoveries. The market cleans itself. Now let's zoom even further out. Bitcoin follows a 4-year rhythm tied to supply issuance. Every cycle looks different on the surface, but the structure remains consistent. Parabolic rise, violent correction, extended consolidation, recovery to new highs. Each cycle, the peak is higher. Each cycle, the drawdown is smaller. That tells us something important. Bitcoin is maturing. As institutional participation increases, volatility decreases. Not disappears, but moderates. Could Bitcoin drop further? Absolutely. Could we see 60,000? 55,000? Possibly. Markets overshoot. Fear exaggerates downside. But for the cycle to break completely, something fundamental would have to fail. The network would need to stop. Security would need to collapse. Adoption would need to reverse. None of that has happened. Blocks are still being produced every 10 minutes. Hash rate remains strong. Transactions continue. Institutions are building infrastructure. Nothing that made Bitcoin valuable at $126,000 has disappeared at $63,000. Only perception has changed. And perception always changes back. This is why Bitcoin deaths exist as a concept. Because every cycle, the same emotional script plays out. At the top, everyone believes it will go up forever. At the bottom, everyone believes it's over. Both are wrong. The truth is boring, slow, and patient. Bitcoin is not dead. It is doing exactly what it has always done, transferring ownership from emotional participants to disciplined ones. So the real question isn't whether Bitcoin survives this. It's whether you allow fear to dictate your decisions. Generational wealth is not built by reacting. It's built by understanding cycles and controlling risk. Near term, nobody knows what price will do. Long term, the architecture remains intact. I trust the network. I trust the engineering. I trust the math, not the obituaries. This is the 406nd time Bitcoin has been declared dead. History suggests it won TB the last. And it won TB the one that S right. If this breakdown gave you clarity, hit the like button. Subscribe to Economic Records for real macro analysis, market cycles, and data-driven insights. And turn on notifications so you don't miss what comes next. See you in the next one.